Hi, I'm Rob. Welcome to my second stock market video. Today I'm going to be covering some basics when it comes to the stock market. After my last video, I received a few questions and I wanted to cover some basics. I hope you find this helpful. The words stocks and shares are used interchangeably. They essentially mean you are buying a portion of the company. By buying shares in a company, you own a portion and therefore are entitled to a percentage of the company's earnings. Although as a common shareholder, you can't have a direct say on how the profits are used. Most companies retain the majority of their profits to reinvest and potentially earn more money from this reinvestment. Let's use Apple as an example. Apple currently has around 16 billion shares in issue. Theoretically, if you could buy 16 million of these 16 billion shares in Apple, you would own 0.1% of the company. Apple at the end of 2020 had a net income of $57 billion. Your 0.1% share would be worth $57 billion that year. Apple currently pays out 21% of its profits back to shareholders as dividends. This is known as the payout ratio. Apple also uses excess cash to buy back shares. This reduces the shares outstanding and therefore increases your holding in the company without increasing the number of shares you own. So what are dividends? They are a payment you receive from owning shares in some companies, and it is a share of their profit. Not all companies pay out dividends. They are usually paid out by older, more established companies. Big growth companies like Tesla, for example, won't pay out as they would rather keep the cash to reinvest. Some companies pay them twice a year or sometimes 4 times a year, known as quarterly. So for example, GSK has been paying an 80p a year dividend since 2015. So if you own one share, you would earn 80p a year from this share. It has a current yield of about 6% to its current share price of 1,300p. Dividend yield is simply the dividend paid per year divided by the current share price. So if you bought £1,000 of GSK a year ago, you would have been paid £60 in dividend, which is obviously 6% of £1,000. GSK has returned 19.4% over the past 5 years, despite poor share price performance, as the dividend has helped increase shareholder return. So obviously you need a place to buy these shares in the companies. So if you live in the UK, here are my top 3 platforms. I used to use FreeTrade, but have recently moved over to Trading 212 a few months ago, just as it has more advanced features and more information on the companies. Both have referral schemes for which you can get a free share worth up to £200 or £100 when you use my link in the description below. eToro is another good platform, however you won't receive any free shares when signing up. So I've had a few people ask me what stocks they should invest in, and often ask me if a certain company is a good buy just because they've heard of it or someone's told them to invest in it. Firstly, make sure you understand the companies that you're investing in. Take the time and do your own research. Secondly, don't take anyone's advice on which stocks to buy. Like anything, you can pretty much guarantee you can find someone telling you to buy a particular stock on Google if you do enough research on it. Now, just because it's hard to take time and do the research to pick the right stocks doesn't mean you have to, or that you can't invest in the stock market. You can invest in what's known as exchange traded funds, also known as ETFs. An ETF is essentially a basket of stocks, so when you buy shares in an ETF, you're essentially buying a small portion of each company within the fund. Some ETFs are sector-based, such as some for renewable energy companies, and some ETFs are country-based. ETFs also help diversify your portfolio. So the S&P 500 is probably the most popular ETF. It tracks the biggest 500 companies in the US. It's very popular because it averages a 7 to 8% return a year. It has, however, had its ups and downs, with the highest average return in 1 year being 38%, and the biggest decline was 37%. Recently, the S&P 500 is widely considered as being overvalued. It has a price-to-earnings ratio of 42.6, with the average for this ETF being around 16%. So what is the price to earnings ratio, also known as PE ratio? Let's look at two examples. GSK, a company mentioned earlier, is a large pharmaceutical company which has a PE ratio of 11.6 at the end of 2020. This is calculated using its earnings per share as well as its shares price. With an earnings per share of 115.9p and a share price of 1,350p, GSK's PE ratio is then calculated by dividing the share price by its earnings per share. Now let's look at Tesla, a company that has only recently become profitable. Tesla has a very high PE ratio of 1,140, calculated by taking their earnings per share of 64 cents and their share price of $729. So another ETF is the FTSE 100. This focuses on the 100 biggest companies in the UK. It has recently had a poor price performance over recent years. However, it does have a fairly high dividend yield of 3.77%. So you will earn 3.77% out as dividends per year. This is over 2.5 times higher than the S&P's 500's dividend yield. Its recent growth has been held back by large oil companies which have the high dividend yields which hold up the overall dividend yield of the ETF. You can also invest in smaller UK-based companies with the FTSE 250, which includes more common names such as Wetherspoons, Marks & Spencers and Greggs. It has slightly better growth over recent years, but has a lower dividend yield. There's also the FTSE All Share, which includes nearly all of the UK listed companies. It is also seen as a better indicator of the UK's economic performance. As mentioned earlier, some ETFs are sector-based. iShares Global Clean Energy holds shares in over 80 companies that have a clean energy focus. Its holdings are rebalanced twice a year and has returned 150% in the past year. However, it is very volatile, mostly because the companies that the ETFs invest in aren't currently profitable. Thanks for watching. Please like the video if you've enjoyed, and if you're considering investing, please use one of my referral links in the description. Thank you.